A storm is quietly brewing beneath the surface of the United States economy, and most people have yet to notice its early signs. Across the nation, companies are struggling and collapsing at speeds not seen in years. Former officials are openly pointing fingers at each other, blaming long-term policies for creating vulnerabilities, while a quiet surge in gold purchases is underway overseas. On their own, these signals may seem small, but together they reveal a far more serious economic picture than headlines suggest. In this video, we will examine 3 major developments reshaping the financial landscape and potentially impacting every household, business, and investor in the country. First, a sharp increase in bankruptcies is sweeping across industries. Firms once considered stable are now seeking protection as debts mount. Sales decline, and credit becomes harder to access. What is striking is that this trend is not limited to struggling companies. Even well-known, previously strong brands are feeling the pressure. The underlying causes are complex. High interest rates are a central factor, hitting firms that borrowed heavily when money was cheap. As these loans roll over into far more expensive debt, many companies are unable to sustain the new repayment burden. Inflation has compounded the problem, pushing up costs for fuel, shipping, raw materials, and wages. Even businesses that planned for growth now see their expenses rising faster than revenue, squeezing profit margins from all sides. Second, Janet Yellen, the U.S. Treasury Secretary, has issued one of her most direct critiques of previous economic policies. She sharply criticized former President Donald Trump's approach, highlighting that years of aggressive tariffs and escalating global tensions left the United States more exposed at a time when economic stability is essential. Her comments are more than political rhetoric. They signal underlying weaknesses in the economy that many experts have quietly noted but rarely explain in detail. Yellen's warnings suggest that structural vulnerabilities, from corporate debt to trade imbalances, have created conditions where even moderate shocks could ripple across multiple sectors. Third, China's massive surge in gold purchases has reverberated through global financial markets. Central banks are increasing their reserves. Traders are flocking to safe haven assets, and gold prices are climbing to unprecedented levels. While some analysts see this as a strategic hedge, others interpret it as a warning about broader instability. Either way, this global shift has implications for the United States, as it highlights the reallocation of financial power and the potential vulnerability of U.S. economic dominance in a changing global system. These 3 developments, rising bankruptcies, critical government warnings, and global financial shifts, are interconnected. The pressures that force companies toward insolvency are amplified by rising interest rates and inflation, which also influence political discussions and trade strategies. China's accumulation of gold and other strategic assets underscores the broader geopolitical dimension, showing how financial decisions in one part of the world can affect markets and companies across the United States. By examining these patterns, viewers can spot early indicators that many analysts may overlook, such as quiet layoffs, incremental defaults, and subtle market shifts that precede major disruptions. Corporate bankruptcies, in particular, reveal the hidden stress in the U.S. economy. Companies that thrived when borrowing was cheap are now facing much higher costs as interest rates rise, forcing them to restructure, downsize, or shutter operations entirely. Inflation has steadily increased operating costs, cutting into profit margins even for firms with strong sales. Rising energy prices, higher wages, and global supply chain disruptions exacerbate these pressures. Many businesses are caught between a rapidly changing market and financial obligations that were manageable just a few years ago. The combination of rising debt costs, higher operating expenses, and declining profitability creates a perfect storm for corporate instability. The broader lesson is clear. These events are not isolated. High-profile bankruptcies, government warnings, and international financial maneuvers all point to systemic pressures that could reshape the economic landscape in the coming months. Investors, business leaders, and ordinary Americans should pay attention to early indicators such as loan refinancing difficulties, rising gold demand, and incremental corporate layoffs. These signals reveal the underlying fragility in a system that outwardly appears stable. Ultimately, the story of the U.S. economy is far more complex than single headlines suggest. It is a combination of rising corporate stress, policy vulnerabilities, and global financial realignments. Understanding these forces is essential to anticipating how markets, employment, and household finances may be affected in the near future. This video will provide a clear step-by-step look at these developments, showing how global power shifts, financial instability, and domestic economic pressures are intersecting in ways that could have profound consequences. Stay with us to the end, because the story unfolding beneath the surface of the U.S. economy is larger, more interconnected, and more urgent than most people realize. From rising bankruptcies to policy critiques and global financial shifts, these are the forces shaping the next phase of economic reality, and recognizing them early can make a difference for investors, businesses, and everyday Americans alike. Supply chain disruptions are emerging as a major force pushing businesses to the brink, creating challenges that ripple far beyond corporate boardrooms. Many companies are still struggling to secure the materials they need on time, while others face sudden spikes in transportation delays, tariffs, or import costs. These disruptions do more than slow production. They generate uncertainty and force firms into costly last-minute solutions. For companies already under financial strain, a single unexpected delay can be enough to tip the balance toward insolvency. What makes this wave particularly alarming is that it is not limited to previously weak or underperforming firms. Even companies that were once considered stable are now failing. Well-known brands in retail, manufacturing, and consumer goods are filing for bankruptcy protection as their business models prove unsustainable under current pressures. Sectors like consumer discretionary, industrials, and retail are bearing the brunt of this trend. Retailers are contending with reduced household spending as consumers pull back on non-essential items, while manufacturers face higher borrowing costs and slower demand from both domestic and international customers. The consequences of these bankruptcies extend far beyond the companies themselves. Each closure results in lost jobs, slower local economic activity, reduced revenue for small suppliers, and decreased business for supporting industries such as logistics, restaurants, and service providers. When a major regional employer collapses, the ripple effects can be felt throughout entire communities. Investors are also exposed. Retirement accounts, pension funds, and individual stockholders can suffer losses when major companies fail, linking corporate instability directly to household financial security. Adding to this pressure are so-called zombie companies, firms that no longer grow or innovate, but survive solely by paying interest on debt without reducing the principal. These businesses could endure during years of low interest rates, but rising borrowing costs now expose their vulnerabilities. Many of these zombie firms are hitting their financial limits leading to abrupt failures that reverberate through markets, amplifying uncertainty for workers, investors, and communities alike. This fragile environment, marked by high debt costs, rising operational expenses, volatile supply chains, and years of stagnant growth, means that even minor shocks can push a company from stability to insolvency. As more firms fail, the risks spread like contagion, affecting the broader economy and creating a feedback loop of uncertainty. Adding to the complexity, U.S. Treasury Secretary Janet Yellen has issued some of her most direct critiques yet regarding past economic policies toward China. She argues that aggressive tariffs and confrontational trade strategies left the United States more exposed and isolated than intended. Rather than strengthening the country, these policies raised costs for American companies, disrupted critical supply chains, and weakened industries that now face fierce global competition. Tariffs intended to pressure China often ended up increasing expenses for U.S. firms themselves, with many costs passed on to consumers. Simultaneously, investment in domestic infrastructure, advanced manufacturing, and digital systems lagged behind global competitors. While other nations built modern industrial hubs and upgraded technology, the U.S. debated and delayed, leaving gaps in areas such as energy storage, robotics, semiconductor production, and other critical sectors. Yellen emphasizes that this underinvestment contributes directly to the country's struggle to maintain competitiveness. She also highlights the strain on alliances and cooperative economic strategies. Policies that distanced the U.S. from long-standing partners made it harder to coordinate trade, supply chain security, and technological standards. As a result, the U.S. faces a strategic disadvantage at a time when global competition is intensifying. Weak supply chains, rising corporate debt, and geopolitical friction converge to create a situation where domestic industries and workers bear the brunt of decisions made years ago. Understanding these dynamics reveals why the current wave of corporate stress is more than a series of isolated failures. It is part of a larger pattern where operational fragility, financial strain, and policy missteps intersect. Supply chain disruptions, coupled with rising interest rates and lingering inflation, force firms into reactive strategies, often at great cost. Even companies that appear resilient are exposed to cascading risks that can quickly escalate into broader economic instability. For households and investors, the impact is tangible. Job losses, reduced business opportunities, and higher prices for goods are direct consequences of these interconnected pressures. For policymakers, it signals the need to balance aggressive economic strategies with measures that maintain domestic competitiveness and supply chain resilience. In short, the current corporate and financial stress in the U.S. is a warning. The system is under strain, and without careful management, even previously stable sectors may face disruption. This is the hidden story behind the headlines: a convergence of supply chain fragility, corporate vulnerability, and structural economic weaknesses, amplified by past policy decisions and global competition. As the situation unfolds, its effects will touch every level of the economy, from Wall Street to Main Street, and will determine whether U.S. industries and communities can weather this growing storm. As a result of past U.S. policies and missteps, other economies have moved to create new partnerships, trade routes, and strategic alliances, while the United States has often been left on the sidelines of critical decisions. This isolation has significant consequences. It reduces the country's influence over global trade rules, weakens its ability to shape economic standards, and makes it increasingly difficult for American companies to operate efficiently abroad. Firms that once relied on predictable trade environments now face added uncertainty, higher costs, and stiffer competition in markets where they previously held an advantage. These shifts tied directly into the rising wave of corporate bankruptcies in the United States. A weaker global position means American businesses are more vulnerable to external pressures. Profitable export opportunities are fewer, operating costs are higher, and competitive advantages are eroded. Companies already struggling with expensive debt, rising inflation, and unstable supply chains find that the added burden of lost international leverage pushes them closer to financial distress. Firms that depended on global markets to stabilize revenues are now exposed to sudden demand drops or intensified foreign competition, spreading vulnerability across multiple sectors, from manufacturing to retail. Industries that rely heavily on imported materials are particularly affected by tariffs, trade restrictions, and supply chain disruptions. Even domestic-only businesses are not immune. As global weakness translates into slower consumer spending, higher input costs, and reduced investor confidence. In this environment, every operational hiccup, be it a delay in shipments, a spike in raw material costs, or an unexpected currency fluctuation, can tip a company toward insolvency. Janet Yellen's recent comments underscore how these pressures are the result of cumulative strategic missteps. U.S. firms today face more stress, less support, and higher exposure to global disruptions than they would have if past policy decisions had prioritized resilience and adaptability. At the same time, global financial behavior is signaling heightened caution. Gold prices have climbed to record highs, driven by multiple forces converging simultaneously. Rising geopolitical tensions, slowing economic growth in several regions, and unpredictable policy shifts have increased global uncertainty. During such periods, investors and central banks seek stability, with gold emerging as the preferred safe haven asset. This time, however, the momentum is particularly fueled by central banks, whose aggressive accumulation of gold is reshaping market dynamics. China, in particular, has been one of the most prominent buyers. Over several months, it has significantly increased its gold reserves while reducing exposure to U.S. Treasury debt, signaling a strategic pivot in its approach to financial risk. This behavior sends a strong message to markets. When a major economic power like China moves decisively into gold, traders interpret it as preparation for potential financial instability or long-term currency risk. Other central banks around the world have followed suit, expanding their gold holdings to shield themselves from volatile exchange rates, debt vulnerabilities, and uncertainties in global financial structures. This activity amplifies the perception of risk and prompts private investors to follow the trend, creating a feedback loop that further elevates demand for gold. The psychology behind this movement is straightforward. Gold is a universal store of value, independent of the performance of any single currency or financial system. Large-scale government purchases often indicate that those with the closest insight into economic fundamentals perceive risks that the broader public may not yet see. It may point to concerns about the long-term value of major currencies, the stability of government bonds, or the robustness of global financial infrastructure. When central banks are preparing for potential shocks, individual investors feel compelled to do the same, reinforcing a global trend toward risk aversion. For the United States, these developments carry profound implications. Rising debt levels and growing interest obligations already put pressure on domestic finances. As foreign powers shift reserves from dollars into gold, it signals a decline in confidence in U.S. currency stability. For decades, The U.S. has benefited enormously from the dollar's status as the world's primary reserve currency, allowing it to borrow cheaply, finance deficits, and exert significant economic influence globally. Increasing gold accumulation abroad hints at a future in which the dollar may no longer enjoy unquestioned dominance, potentially reducing U.S. leverage in international trade and finance. The confluence of corporate bankruptcies, strained global influence, and strategic gold accumulation highlights a complex and interlinked set of pressures facing the U.S. economy. Operational stress, financial fragility, and shifting global confidence are not isolated phenomena. They reinforce one another, creating a more vulnerable and unpredictable economic landscape. Businesses must navigate higher costs, disrupted supply chains, and intensifying competition, while policymakers contend with a world increasingly less reliant on the dollar. Investors and consumers feel the consequences through rising prices, fewer market opportunities, and increased volatility. Ultimately, these signals, rising bankruptcies, reduced international influence, and surging gold purchases, suggest that structural pressures are building beneath the surface of the U.S. economy. The situation calls for careful observation, strategic adaptation, and an understanding that global financial dynamics are evolving rapidly. The dollar's past dominance may no longer guarantee security, and the decisions of foreign governments, particularly regarding safe haven assets like gold, could shape the trajectory of U.S. economic power for years to come. Recognizing these trends now provides the insight needed to prepare for a more complex and interdependent global financial future. A shift in global reserve strategies impacts far more than symbolic influence. It has tangible effects on borrowing costs, fiscal stability, and the broader economic framework. When fewer countries choose to hold U.S. debt, the cost of borrowing rises, placing additional strain on the federal budget at a time when national debt is already at historic highs and interest payments consume an ever larger portion of government revenue. This reduced appetite for dollars and U.S. bonds can slowly reshape financial markets, undermining the traditional advantages the United States has long enjoyed and making it increasingly difficult to sustain its current economic model. Rising gold demand further reflects deeper anxieties about inflation, currency devaluation, and the long-term resilience of global trade and financial systems. As nations diversify away from dollars and increase gold holdings, they signal a lack of confidence in the stability of the U.S. currency and its ability to serve as a reliable store of value. For the United States, this pivot is a warning. The dollar's dominance may not be as unshakable as past decades suggested, and global investors are beginning to hedge against potential disruptions. When these developments are considered together, a broader pattern emerges, revealing a U.S. economy under mounting pressure. Corporate bankruptcies illustrate the fragility of the domestic business landscape. Companies that once seemed robust are now faltering under the combined weight of higher borrowing costs, inflationary pressures, and unpredictable demand. This domestic weakness exposes systemic vulnerabilities that were masked during periods of cheap credit and rapid expansion. Businesses are increasingly strained, particularly those operating in capital-intensive sectors, where any disruption in financing or supply chains can cascade into financial distress. Government policy has also come under scrutiny. Janet Yellen's recent remarks highlight structural weaknesses created by past decisions. Tariffs, underinvestment in critical industries, and strained international alliances have left the United States with fewer tools to respond to economic shocks. These policy missteps have not only increased costs for American firms, but also reduced competitiveness globally, creating an environment where even minor domestic or international disruptions can produce outsized effects. External pressures compound the challenge. China's aggressive accumulation of gold, combined with broader central bank demand for safe haven assets, underscores a global shift away from dollar dependence. Rising uncertainty in financial markets magnifies these risks, sending signals that the U.S. may face diminished influence over global financial leadership. These global trends intersect directly with domestic economic pressures, creating a multidimensional stress on the U.S. system. High debt, slower economic growth, and fragile corporate structures amplify the impact of external moves, while internal weaknesses make the country more susceptible to financial shocks. Each of these factors alone is concerning, but together they form a convergence of risks. Domestic bankruptcies destabilize local economies, reduce consumer confidence, and depress investment. Policy gaps weaken the country's capacity to respond effectively to market shifts. International shifts in reserves and the increasing preference for gold add a layer of uncertainty that cannot be controlled domestically. This convergence creates a system where seemingly minor events, a sudden rate change, a supply chain disruption, or geopolitical tension, can trigger significant cascading consequences. The interconnectedness of domestic fragility and global uncertainty becomes increasingly clear. A single disruption reverberates across industries, financial markets, and households. Corporate bankruptcies are one of the clearest indicators of the pressures building beneath the surface, showing which sectors are most vulnerable and highlighting the systemic risks that ordinary economic data may obscure. Meanwhile, gold accumulation and shifts in global reserve strategy reveal confidence trends that foreshadow potential challenges for U.S. currency dominance. In essence, the United States is experiencing overlapping internal and external stressors. Domestic weaknesses, policy miscalculations, and global realignments are intersecting at a critical moment. It is as if a house of cards is being tested from multiple angles. One layer sags under corporate bankruptcies, another shakes under strategic missteps, and a third shifts as global powers reposition their reserves and influence. In this environment, even small shocks can trigger larger consequences, highlighting the precarious balance that has sustained the economy for decades. Understanding these dynamics requires attention to a few key indicators. Bankruptcy filings, shifts in central bank reserves, and movements in gold prices provide early warning signs of where pressure is building. Observing these metrics allows policymakers, investors, and the public to anticipate potential disruptions before they escalate into systemic crises. By connecting the dots between domestic fragility and international shifts, it becomes possible to see the full picture of economic vulnerability, one shaped by internal imbalances, policy decisions, and the evolving landscape of global finance. The narrative is clear. The United States is facing simultaneous internal and external pressures that threaten its economic stability. High debt, fragile corporate health, policy missteps, and global shifts in reserves and safe haven assets converge to create a uniquely precarious moment. The patterns emerging in bankruptcy filings, interest costs, supply chain stress, and gold accumulation are all signals that the traditional safeguards of U.S. financial and economic dominance are under stress. For anyone watching closely, these signals point to a critical need for strategic awareness and timely action, as the interplay between domestic fragility and global uncertainty may determine the trajectory of the U.S. economy for years to come. When the number of companies entering bankruptcy rises month after month, it signals that firms are running out of options, struggling to manage mounting debts, and facing operational costs that have become unsustainable. Monitoring these filings provides an early indicator of stress across key industries, including retail, manufacturing, and transportation, revealing vulnerabilities before they appear in broader economic reports. The pace of bankruptcies shows where systemic pressure is building, highlighting the sectors most at risk and how widespread the strain may be. Interest rate decisions from the Federal Reserve provide another critical signal. Every increase in rates raises borrowing costs for businesses, homeowners, and financial institutions. Even when the Fed pauses its hikes, the prevailing level of interest rates still matters significantly because companies must refinance older loans at today's higher rates. Observing upcoming Fed meetings, official statements, and subtle shifts in policy language can offer clues about whether financial conditions are likely to tighten further in the months ahead. A small adjustment in rates can ripple through the economy, affecting cash flow, investment plans, and expansion strategies. Gold and other precious metals are also powerful indicators of financial stress. When gold prices rise sharply, it usually reflects increased fear or uncertainty in global markets. Heavy demand from governments, central banks, institutional investors, and private buyers suggests that confidence in traditional currencies or long-term financial stability is weakening. Tracking price movements in gold, silver, and industrial metals can reveal how investors are positioning themselves in response to perceived risks. These signals often precede visible economic disruption, offering a chance to act before crises materialize. Policy changes in China carry equal weight in this context. China remains a central player in global trade, manufacturing, and currency markets. Decisions to increase gold reserves, alter import or export rules, or adjust macroeconomic targets have far-reaching consequences. Such moves can trigger sudden fluctuations in commodity prices, shipping costs, and investment flows, impacting not only China, but economies worldwide. Paying close attention to these developments allows for a better understanding of how international factors intersect with domestic vulnerabilities. For individuals and investors, there are practical steps to help mitigate risk in this environment. Diversifying savings and investment portfolios across multiple asset classes reduces exposure to any single sector or financial instrument. Awareness of job risk in vulnerable industries, such as retail, construction, transportation, and technology, is crucial, especially as layoffs often rise in these areas during economic slowdowns. Staying informed through concise and accurate economic updates helps identify sudden changes that may affect wages, prices, or business stability. While this is not a prediction of impending disaster, it underscores that surface-level stability can mask deeper pressures. Small signals often precede larger shifts, and recognizing these early can provide an advantage in preparing for potential challenges. The signs explored today point to three major forces shaping the current economic landscape. First, the rising wave of bankruptcies reveals the immense pressure facing American companies, highlighting weaknesses in the corporate sector that may not yet be widely recognized. Second, Janet Yellen's sharp critique of past economic policies emphasizes structural issues that have left the United States less resilient in a rapidly evolving global economy. Her remarks suggest that tariff wars, underinvestment in critical industries, and strained international alliances have all contributed to a system now more vulnerable to shocks. Third, China's accelerated accumulation of gold reflects growing concern over global uncertainty and signals a shifting confidence in the long-term stability of financial systems, especially the dominance of the US dollar. Individually, each of these elements is significant, but together, they reveal an interconnected system under stress from multiple directions. Rising bankruptcies undermine consumer confidence and employment. Government policies reveal structural weaknesses, and international financial maneuvers indicate that global power and trust in existing economic structures are in flux. This convergence creates an environment where minor disruptions, a supply chain delay, a sudden rate hike, or geopolitical tension can quickly escalate into larger economic consequences. As corporate failures mount, policy is scrutinized, and financial actors seek refuge in gold. It becomes clear that the economic landscape is more fragile than it appears. This is not mere speculation. These patterns are measurable, trackable, and increasingly visible across multiple indicators. Observing trends in bankruptcy filings, interest rates, commodity prices, and international reserve strategies provides a comprehensive picture of stress building beneath the surface of the U.S. economy. For viewers, understanding these signals is essential for navigating the uncertainties ahead. By recognizing early warning signs, individuals and businesses can make informed decisions to protect savings, adjust investment strategies, and prepare for potential job market fluctuations. The combination of domestic weaknesses, structural policy challenges, and global shifts in financial confidence underscores the need for vigilance and strategic planning. In short, America's economic environment is facing pressures from both internal vulnerabilities and external global forces. Rising bankruptcies, structural policy gaps, and the global pivot towards safe haven assets like gold all point to an economy under stress, where even small shocks could produce outsized effects. This interconnected landscape demands careful observation, prudent action, and a clear understanding of the forces at play. If you found this breakdown valuable, make sure to hit like and subscribe to our channel. We will continue monitoring these developments and delivering clear, straightforward explanations of the economic stories that truly matter, helping you stay informed and prepared for what lies ahead.